Welcome back to another episode of our channel. Today we're diving into our very own 5-minute stochastic scalping trading strategy. It's simple, yet highly profitable. If you enjoy our content and want to see more videos like this more often, don't forget to hit the like button, subscribe, and turn on notifications so you never miss an update. Also, please consider sharing this video across your WhatsApp, Facebook, and Twitter accounts to show your support. Now, let's jump right into it. Before we delve into the content of this video, it's crucial to highlight a significant point. The principles we're about to discuss are applicable across various trading arenas, including currency, stock, and cryptocurrency trading. This is because price action tends to exhibit a consistent pattern across different assets. So in this video, we'll be diving deep into the intricacies of these concepts. In this video, you will learn a scalping strategy that works across the Forex market, indices, stock market, and cryptocurrency. This particular strategy thrives on the 5-minute chart, although it can also be effective on the 1-minute and 15-minute time frames. The stochastic scalping strategy enables traders to capitalize on incremental profits over short durations. These small gains, accumulated over time, can grow into significant returns, making it a potentially lucrative approach for traders. Scalping involves profiting from minor fluctuations in an asset's price, as these smaller movements occur more frequently than larger ones, even in relatively stable markets. This abundance of small movements provides ample opportunities for scalpers to extract profits. Scalpers may execute numerous trades in a single day, aiming for modest gains with each transaction. However, this strategy demands constant vigilance and rapid decision-making, as scalpers must closely monitor market movements. Consequently, it's best suited for individuals who can dedicate considerable time and focused attention to trading. Scalping isn't for everyone. It requires the ability to handle the fast-paced and demanding nature of this style of trading. While it may not yield significant wins in every trade, it can generate consistent profits over time for those who are patient and disciplined enough to stick with it. If you decide to scalp using the 5-minute stochastic indicator, there are several crucial considerations to keep in mind. 1. Trade the most liquid markets. Focus on trading the most liquid markets, such as major Forex pairs like the British pound-US dollar. These pairs typically offer tight spreads due to their high trading volume, which is essential since you'll be entering the market frequently. 2. Trade during busy times. As a scalper, aim to trade during the busiest times of the day when market liquidity is at its peak. This usually occurs during the overlap of major trading sessions, such as when London and New York are both actively trading. 3. Account for spread costs. Given the frequency of your trades, spreads will significantly impact your overall profitability. Be mindful of transaction costs associated with each trade, as excessive trading costs can erode your profits. 4. Focus on one pair. Initially concentrate your efforts on mastering one currency pair first. Scalping demands intense focus and concentration, so attempting to scalp multiple pairs simultaneously, especially as a novice, can be overwhelming and counterproductive. 5. Implement sound money management. Adhere to proper risk management practices, especially considering the high frequency of trades involved in scalping. Ensure that each trade aligns with your overall risk tolerance and trading strategy. 6. Be cautious around major news releases. Stay informed about upcoming economic events and major news reports, as they can introduce significant volatility and slippage into the market. Trading around such events carries increased risk, so exercise caution and consider adjusting your trading approach accordingly. By incorporating these considerations into your scalping strategy, you can enhance your chances of success and navigate the challenges associated with this intensive trading style effectively. Please like the video and subscribe to the channel. Let's add the indicators to the chart. Go to the TradingView website and search for the 3 EMA indicator, then add it to the chart. Enter the indicator settings, go to the Inputs tab, and change the length of the first moving average to 50. Then change the length of the second moving average to 150. Go to the Style tab and deactivate the 200-period moving average. Go back to the Indicators tab and search for the stochastic indicator, then add it to the chart. Go to the indicator settings and from the Inputs tab, change the K length to 5. Then adjust the K smoothing to 5 and finally, set the D smoothing to 5. An overbought condition occurs when the stochastic reading rises above 70. Conversely, oversold conditions are indicated when the stochastic reading falls below 30. A sell signal is generated when the oscillator reading surpasses the 70 level and then retreats below 70. Conversely, a buy signal occurs when the oscillator drops below 30 and then rises back above 30. Overbought and oversold levels suggest that the security's price is nearing the top or bottom of its trading range for the specified time period. These levels can provide insights into potential reversals or corrections in price movements. Rules for entering a long position. When the 50-period moving average crosses above the 150-period moving average, indicating an uptrend, only look for long positions. In these conditions, when the price reaches the 50-period and 150-period moving averages, they form a strong support, and we look for buying opportunities on the pullback to these two moving averages. When the price reaches the moving averages and finds support, look for candlestick patterns to confirm entry into a long position. When you identify an uptrend candlestick pattern, check the stochastic oscillator. When the fast blue line of the stochastic oscillator crosses above the slow orange line from within the oversold region or below the 30 level in the stochastic, a clear buy signal is generated. It's crucial that the crossover occurs and remains above the oversold region. After meeting this condition, you can initiate a buy order. For risk management, place your stop loss order approximately 2 pips below the support level. This helps mitigate potential losses if the trade moves against you. Set your take-profit ratio to 1:2 for better risk-reward ratio. Consider using a trailing stop technique for maximizing profits. Rules for entering a short position when the 50-period moving average crosses below the 150-period moving average, indicating a downtrend, only look for short positions. In these conditions, when the price reaches the 50-period and 150-period moving averages, they form strong resistance, and we look for selling opportunities on the pullback to these two moving averages. When the price reaches the moving averages and fails to break above the formed resistance, look for candlestick patterns to confirm entry into a short position. When you identify a downtrend candlestick pattern, check the stochastic oscillator. When the fast blue line of the stochastic oscillator crosses below the slow orange line from within the overbought region or above the 70 level in the stochastic, a clear sell signal is generated. It's crucial that the crossover occurs and remains below the overbought region. After meeting this condition, you can initiate a sell order. For risk management, place your stop loss order approximately 2 pips above the resistance level. This helps mitigate potential losses if the trade moves against you. Set your take-profit ratio to 1:2 for better risk-reward ratio. Consider using a trailing stop technique for maximizing profits. To support us, please like the video and subscribe to the channel. Pay attention to these examples. As you can see, when the price forms higher highs and higher lows, it indicates an uptrend. Additionally, the 50-period moving average has crossed above the 150-period moving average, and the price is pulled back to the 150-period moving average. Now, look at the stochastic oscillator indicator. The price is in the overbought zone and has risen above the 30 level. The blue line has crossed above the orange line. In these conditions, I open a long position. I place the stop loss below the support level and set the take profit with a risk-reward ratio of 1:2. Let's see the result. You can use the stochastic oscillator indicator to exit the trade. When the price reaches the overbought zone, you can exit the position. Please like the video and subscribe to the channel. Here I've selected a 5-minute time frame chart of gold. As you can see, the price is forming lower highs and lower lows, indicating a downtrend. The 50-period moving average is below the 150-period moving average. The price has reached a resistance zone and a bearish engulfing candle has closed. Look at the stochastic oscillator indicator. The blue line is crossed below the orange line and entered the overbought zone. In these conditions, I open a short position. I place the stop loss above the resistance zone and set the take profit with a risk-reward ratio of 1:2. Let's see the result. If you've enjoyed the video and found it helpful, please support us by liking and subscribing to the channel. Share the video with your friends so everyone can benefit from it. Looking forward to seeing you in the next video. Stay tuned and best of luck.